Good evening. I'm speaking with you at a moment when the financial landscape is shifting in ways that most investors haven't yet recognized. Not because the signs are hidden, but because we've trained ourselves not to see them. Over the past several weeks, something quiet but significant has occurred in precious metals markets. Not a spike, not a headline-grabbing surge, something more deliberate, something that suggests a structural change is underway, one that may reshape how a thoughtful investor should think about gold and silver for the next decade. This isn't a prediction. This isn't hype. This is a conversation about probability, about cycles, and about what happens when the incentives facing policymakers begin to align with an asset class that has been dismissed for far too long. If you hold gold or silver, what I'm about to walk through will help you understand what may be happening beneath the surface. If you don't, this will help you understand whether you should be thinking about it differently than you were 3 months ago. Let's begin. The financial system operates on incentives. Nations, central banks, investors, and policymakers all respond to incentives. For the past 15 years, the incentive structure strongly discouraged belief in precious metals. Real interest rates were rising, the dollar was strengthening, technology was ascending, gold was the relic of a bygone era. That narrative was reinforced constantly, and for many investors, it became truth. But incentives have a way of shifting when conditions change enough. Here's what's different now. The United States federal government is running budget deficits that have moved from unsustainable to openly acknowledged as a structural problem. We're not talking about temporary wartime spending or a cyclical downturn. We're talking about a permanent fiscal gap, one where spending exceeds revenue not by a small margin, but by a significant one, year after year, with no political will to close it. This creates a choice, not for you or me, but for policymakers. They can raise taxes substantially, cut spending substantially, or they can inflate their way through the problem. History tells us which option governments typically choose. When a government chooses inflation as a solution, the value of its currency declines. This isn't a theory, it's accounting. If you increase the supply of money faster than the supply of goods and services, the purchasing power of that money falls. It always does. Now here's where the incentive structure becomes relevant to precious metals. When currency values are under pressure, when inflation is acknowledged as a problem rather than a temporary inconvenience, when interest rates begin to tell a different story about future inflation expectations, suddenly, assets that hold value independent of any government's promise become valuable again. Not exciting, not speculative, valuable. Gold and silver hold intrinsic worth. They cannot be printed. They cannot be devalued by monetary policy alone. They exist outside the system of promises and obligations that underlies fiat currency. In times of currency uncertainty, this matters more than it has in a generation. The reason most investors remain skeptical of precious metals isn't stupidity. It's recency bias combined with a misunderstanding of how financial cycles work. For roughly 15 years, from 2011 to 2025, gold and silver underperformed stocks. This created a powerful psychological association. Precious metals are for the fearful, the paranoid, the contrarians who got it wrong. Meanwhile, the people who owned technology stocks became wealthy. The narrative reinforced itself. What investors missed during this period was that they were living through a historically unusual set of conditions. Real interest rates were rising. The dollar was strengthening. Technology genuinely was creating wealth in new forms. These conditions do suppress precious metals valuations. That's not a myth. That's how markets work. But conditions are reversing. Real interest rates are no longer rising. They're compressing. The dollar, while still relatively strong, is beginning to show signs of structural weakness under the weight of fiscal deficits. Technology stocks have been repriced upward to levels that assume perfection in execution. And the macroeconomic backdrop has shifted from we will tighten our way to stability to we will navigate through this with accommodative policy and currency management. Most investors haven't updated their mental model to reflect these changes. They're still thinking about precious metals through the lens of 2015 when the conditions truly were unfavorable. This is a common mistake in investing. We become confident in a narrative precisely when it's about to change. The other source of confusion is that investors don't understand the relationship between policy incentives and asset prices. They see gold rising and they think it's a bubble. They don't recognize that it's responding to a genuine change in the incentive structure facing policymakers. When governments are backed into a corner by their own fiscal choices, they tend to make decisions that benefit hard assets. This isn't cynicism, it's pattern recognition. If you want to understand what might happen next, you need to understand what happened before. Not perfectly. History never repeats exactly, but in its broad outlines, it does rhyme. In the 1960s, the United States was running persistent fiscal deficits. These deficits were partly due to the Vietnam War, partly due to social programs, and partly due to a culture of political spending. The government faced the same choice that policymakers face today: raise taxes, cut spending, or inflate. They chose inflation. Has inflation accelerated? Foreigners who held dollars began to worry about the value of their holdings. They asked, why should we hold currency that's being debased? And they began to exchange their dollars for gold. This created a bank run on gold, not on a bank, but on the gold reserve system itself. By 1971, the pressure became unsustainable. President Nixon closed the gold window. The dollar was no longer convertible to gold at a fixed price. Floating exchange rates were born. And gold, which had been artificially suppressed in price, began a historic multi-year run upward. From 1971 to 1980, gold rose from roughly $35 per ounce to over $800 per ounce. That's not a doubling. That's a more than 20-fold increase. Silver's move was even more dramatic. Now, I'm not saying that exact scenario will repeat. The institutional framework is different. The economics are more complex, but the underlying incentive structure is the same. When a government has run out of other options and chooses to allow currency devaluation through inflation, hard assets tend to appreciate substantially. The difference now is that people understand this. The market is not pricing gold as if it's 1971, where the move is a surprise. It's pricing it as if this outcome is becoming increasingly probable. That's different, and it's more interesting, because it means we're likely past the phase of dramatic surprises and entering a phase of steady repricing. Let me be specific about the mechanics of how we get from here to a place where precious metals are significantly more valuable. The United States carries a national debt of approximately $36 trillion. This debt grows at roughly $1.5 trillion to $2 trillion per year, even as the economy grows. This means the debt is expanding faster than the ability to service it without increasing the debt-to-income ratio further. And when a household's debt grows faster than its income, eventually something has to give. The same principle applies to nations, though nations have more options because they can issue currency. To service this debt, the government must pay interest. As interest rates are higher now than they were 5 years ago, the interest burden is rising. This creates pressure. Spending on interest reduces the money available for other priorities. Either taxes must rise, spending must fall, or the government must borrow more. If the government borrows more, debt continues to accelerate. If taxes rise too much, the political cost is prohibitive. If spending falls, the immediate economic impact is negative. So what happens? Inflation. When you inflate, you reduce the real value of debt. A dollar of debt owed becomes less valuable if the purchasing power of the dollar falls. This is a subtle form of default, not a failure to pay nominally, but a reduction in real value through currency devaluation. Markets are beginning to price in the probability that this is the chosen path. And when investors price in currency devaluation, they move money into assets that hold value independent of currency. There's a technical reason why this moment is particularly interesting for precious metals, and it relates to real interest rates. Real interest rates are the return you earn on a bond or savings account, adjusted for inflation. If a bond pays 5% interest and inflation is 3%, your real return is roughly 2%. For most of the 2010s, real interest rates were negative or very low. This meant savers were losing purchasing power by leaving money in bonds. In that environment, gold, which pays no interest but holds value, began to look attractive. The move from 2018 to 2020 reflected this. Since 2022, however, real interest rates have been positive and at times quite high. This meant bonds were paying savers a real return. Gold became less attractive on a relative basis. This is why gold struggled to make new highs, even as people talked about inflation. But here's what's changing. Real interest rates are beginning to fall again. This can happen for one of two reasons. Either nominal interest rates fall, the Fed cuts rates, or inflation rises, the real return on bonds falls even if nominal rates stay steady. Most likely, both will occur to some degree. As real interest rates compress, the opportunity cost of holding gold falls. Gold starts to look expensive relative to bonds, not because gold is expensive, but because bonds stop paying you for the risk of holding them. This is when precious metals tend to make significant moves upward. The signal we're watching for is a persistent decline in real interest rates, particularly if it occurs alongside evidence that inflation is not being controlled. We're seeing preliminary signs of this. It's not guaranteed, but the probability is rising. There's another layer to this that most retail investors don't appreciate: the international role of the dollar. The United States dollar is the world's reserve currency. This means that foreign governments, corporations, and investors hold dollars not just as an investment, but as a store of value and medium of exchange. This role gives the dollar structural demand that most currencies don't have. But this role comes with responsibility. When other nations become concerned that the dollar is being debased through inflation, they begin to diversify away from it. They buy other currencies, other assets, and yes, gold. We're seeing this dynamic accelerate. Central banks around the world have been net buyers of gold for several years now, not traders looking for quick profits, but holders looking for stable value. This is a meaningful signal. Central bankers are not emotional. They're not driven by hype. They're responding to economic incentives, the same incentives that suggest the dollar is under pressure. When central banks move, it tends to be ahead of retail investors. By the time the average person realizes the dollar is in trouble, the sophisticated holders have already positioned themselves. This is not a conspiracy. It's how information moves through markets. The implication is that we may be in the early stages of a long-term diversification away from dollar-denominated assets. Precious metals are one beneficiary of this shift. They're also a hedge if you believe, and many sophisticated investors do, that dollar weakness is coming. Let me take a step back and talk about psychology for a moment, because this is where most investors go wrong. For 15 years, the narrative in financial media was consistent. Precious metals are a relic. Cryptocurrency is the future. Stocks always win. Real estate always appreciates. Follow the trend, don't fight it. This narrative was reinforced by performance. People who listened to it made money. People who were skeptical looked foolish. This created enormous social pressure to believe the narrative, not through explicit coercion, but through the simple fact that being right is rewarded and being wrong is punished. But financial markets are cyclical. What works doesn't work forever. When a cycle turns, the narratives that were true become false, but psychologically, most investors are unable to update their beliefs until the new reality has already priced in. This is where we are now. The narrative is beginning to shift. Gold is no longer a relic. It's a hedge against policy uncertainty. But most investors haven't internalized this yet. They're still in a state of cognitive dissonance, acknowledging rising gold prices while maintaining their mental model that gold doesn't matter. Eventually, this dissonance resolves. Either gold falls and the old narrative reasserts itself, or gold continues to rise and investors update their beliefs. Based on the macroeconomic backdrop, the latter seems more probable. But markets move at the margin, and it takes time for belief to shift. The people who will profit most from this cycle are those who understand the shift early and position themselves accordingly. Not dramatically, not leveraged, but deliberately over time, as new information confirms the thesis. If you already hold precious metals, what does this mean for you? First, understand what you own and why you own it. If you hold gold or silver as a hedge against specific macro outcomes, currency devaluation, fiscal crisis, geopolitical instability, then you own it for exactly the scenario that is becoming more probable. That's a reason to hold, not to sell. But holding and holding well are different things. Holding well means several things. First, it means having the right allocation. Most advisors suggest precious metals should represent a small portion of a diversified portfolio, perhaps 5 to 10%. This is not enough to make you wealthy if precious metals soar, but it's enough to hedge your downside if the macro scenario deteriorates. This is the right position for most investors. You're not betting your future on precious metals. You're protecting your portfolio against a specific risk. Second, it means resisting the urge to trade around your position. If gold rises 30%, the temptation to sell some and take profits is powerful. Resist it. Professional investors understand that the real move in a cycle tends to happen after the asset has already appreciated significantly. If you sell too early, you capture a fraction of the gain. If you hold, you capture more. This requires discipline. Third, it means being psychologically prepared for volatility. Precious metals can fall 20, 30, or even 40% in a short period. This doesn't mean the thesis was wrong. It means markets are noisy. If you can't tolerate this volatility without panicking, you own too much. Adjust your position so that you can hold through the noise. Fourth, it means tuning out the headlines. Every day there will be an article explaining why gold is overvalued or why it will fall. Some of these articles will contain truth. Most will contain noise. Your job is not to respond to every article. Your job is to maintain a long-term perspective and rebalance occasionally as your circumstances change. Finally, if you have already held gold or silver through a multi-year decline and you're now seeing it appreciate, congratulations. You have the psychology of a good investor. You didn't panic sell at the lows. This is rarer than you might think. Don't squander this discipline by overtrading now. If you don't hold precious metals and you're wondering whether you should, here's a thoughtful approach. First, educate yourself. Don't buy an asset because you heard about it on social media or because someone made a compelling argument. Read about the history of precious metals. Understand their role in financial systems. Understand the arguments for and against holding them. Only after you've genuinely educated yourself should you consider making a purchase. Second, understand your own macro view. Do you believe the United States will successfully address its fiscal deficits through a combination of spending cuts and tax increases? If yes, precious metals are less relevant. Do you believe the government will eventually choose inflation, whether explicitly or implicitly, as the path of least resistance? If yes, precious metals are more relevant. Your answer to this question should drive your allocation decision, not the performance of gold over the past few months. Third, buy slowly and deliberately. Don't put a year's worth of money into precious metals in a single purchase. Buy small amounts over time. This serves several purposes. It reduces the psychological impact of volatility. It ensures you have capital available if prices fall further and you want to add. And it reduces the risk that you buy at the worst possible time. Deliberate purchasing, over a period of months or quarters, is the approach of someone thinking clearly rather than reacting emotionally. Fourth, understand the mechanics of purchasing. Do you buy physical gold and silver and store it yourself? Do you buy through an ETF? Do you buy mining stocks? Each approach has different risk and return characteristics. Physical gold is pure exposure to the price of gold, but has storage and insurance costs. ETFs are convenient, but introduce counterparty risk. Mining stocks offer leverage to precious metals, but add company-specific risk. Understand these trade-offs before you invest. Fifth, have a thesis and a time horizon. If you believe precious metals will be higher in 5 or 10 years due to structural macro reasons, then you should be able to tolerate a scenario where they're lower in the next 6 months. You have time. If you're trying to make quick profits, you're likely to get shaken out at the worst moment. A longer time horizon gives you the gift of patience. Finally, be honest about your motivation. If you're buying precious metals because you believe in the long-term macro thesis and want to protect yourself against devaluation, that's rational. If you're buying because you feel like you're missing out and you see prices rising, that's emotional. Only the former is likely to end well. Let me be very clear about the mistakes that destroy investors in situations like this. First, do not overlay leverage. Precious metals are volatile. If you use leverage, if you borrow money to buy gold or silver, you're taking a bet that not only rises, but that it rises enough to cover your borrowing costs before any volatility shakes you out. This is how people blow up their accounts. Buy with money you have, not money you borrow. Second, do not chase headlines. Every time gold rises significantly, there will be articles explaining why it will rise forever. Every time it falls, there will be articles explaining why it will fall forever. Both articles cannot be true. Both will be written regardless of the underlying facts. Your job is to ignore the noise and maintain your thesis. Third, do not confuse conviction with certainty. I've laid out a case for why precious metals might appreciate significantly, but I haven't guaranteed it. Nobody can. Markets are driven by the marginal buyer and seller, and those people's expectations can shift. You should hold precious metals as part of a portfolio, not as the entirety of your portfolio. Diversification is not a sign of weakness, it's a sign of clear thinking. Fourth, do not try to time the market. If you believe the thesis, you don't need to buy at the exact bottom or sell at the exact top. You need to buy at reasonable prices and hold for a reasonable time. Professional investors miss bottoms and tops all the time. What they don't miss is the bulk of the move. Start investing when you've done your research, not when you think you found the perfect timing. Fifth, do not share your portfolio with everyone you know. This is particularly important with precious metals, which still carry a cultural association with conspiracy thinking. When gold is rising and people around you are struggling financially, telling them about your gold position can create resentment or pressure you to make decisions based on social approval rather than sound reasoning. Keep your portfolio private. Sixth, do not assume this cycle will be identical to past cycles. Financial history rhymes, but it doesn't repeat exactly. Gold rose from 1971 to 1980, but the specific path was different each year. The global economy is more interconnected now. Policy tools are more sophisticated. Cryptocurrencies exist. This doesn't invalidate the thesis that precious metals will appreciate in a devaluation scenario, but it means specifics may surprise you. Stay flexible. Finally, do not panic sell at the first sign of trouble. In every bull market, there are corrections that feel like the end of the world. They're not. If you sell during these corrections, you lock in losses. If you hold through them, you capture the recovery. This is not optimism, it's probability. Corrections happen in bull markets all the time. Selling during them is a way to turn temporary setbacks into permanent losses. I notice we're living in a period where policy signals are becoming increasingly important to precious metals valuations. A new administration brings different priorities and different incentive structures. Let me be clear about something. I'm not going to make this about Trump specifically or any political figure specifically. That's not the point. The point is that policy shapes incentives, and incentives shape asset prices. What matters is whether the new administration will prioritize fiscal discipline or allow deficits to expand further. What matters is whether they'll support a strong dollar or be comfortable with dollar weakness if it helps with other policy goals. What matters is whether they'll work with the Federal Reserve on inflation control or pressure the Fed in other directions. These are not predictions I'm making with certainty. These are questions where the incentive structure suggests particular answers, but the future is never certain. What we know is that investors are watching for signals. When those signals suggest policy will be accommodative to inflation, either through continued deficits, pressure on the Fed, or trade policies that might increase prices, precious metals tend to perform well. The reason gold and silver have strengthened recently is not because Trump will definitely do X or Y. It's because there's increased probability that policy will be structured in ways favorable to precious metals. Markets price in probabilities, not certainties. The title of this video mentions the idea of a permanent price floor. Let me explain what that means and why it might actually be true. A price floor exists when something becomes so valuable to policymakers that they won't allow it to fall below a certain level. For most of history, gold served as exactly this. Governments understood that when gold fell below a certain price, people stopped believing in the currency and the financial system itself, so they supported gold prices to maintain faith in currency. When Nixon closed the gold window, that explicit price floor disappeared. Gold became a freely traded commodity. But the question now is whether a new price floor is emerging. If the United States government and other governments decide that a particular level of gold prices is necessary to maintain confidence in currency and the financial system, they might support gold at that level through open market operations or policy choices. This wouldn't be a conscious coordination that you'd read about. It would be implicit in their policy choices. The thesis is that we're approaching a point where governments will find it in their interest to support gold prices above current levels. Not because gold is magic, but because its utility as a confidence asset makes it valuable to the people running the system. If this thesis is correct, it has profound implications. It means gold isn't just a speculative asset or a hedge. It becomes a strategic asset that is implicitly supported by policy, that changes the risk-reward calculation significantly. The challenge with this thesis is that it's difficult to prove in real time. You won't find explicit statements from central bankers saying they're targeting gold prices. But you can see it in their actions, their purchases, their policy statements, the way they discuss inflation and currency stability. Let me zoom out and talk about financial history for a moment. Asset cycles have a consistent pattern. An asset becomes undervalued because it's out of favor. Contrarian investors quietly begin to accumulate it. For a while, nothing happens. Frustration builds among the contrarians. But then, conditions change. The reasons for undervaluation fade. Early believers are proven right. Then, as the asset begins to appreciate, more investors notice. Initial appreciation attracts attention. More attention brings more capital. The asset rises faster and faster. Eventually, it becomes obvious to everyone. It's in the news all day. Everyone is talking about it. New investors who know nothing about the underlying reasons pile in. At this stage, the asset typically becomes overvalued. It rises too far, too fast. Eventually, something gives. Prices fall. Many of the recent entrants panic sell. The cycle resets. The question for precious metals right now is, where are we in this cycle? My assessment is that we're in the early middle stage. We're past the nobody believes in it stage. Sophisticated investors have accumulated. Prices are rising. But we're not yet at the everybody believes in it stage. There's still skepticism. There's still debate. There's still an opportunity for deliberate investors to position themselves without fighting against overwhelming optimism. This stage typically lasts for a few years, maybe longer. It's not the highest return stage that comes when everyone piles in later, but it's the stage where you can accumulate without the pressure of FOMO. This is actually the best stage to be investing, because you have time and limited competition for the opportunity. Let's talk about how a thoughtful investor constructs their overall portfolio in this environment. Start with your core holdings. Your core should be diversified across stocks, bonds, and alternative assets. This core should reflect your long-term goals and your risk tolerance. It should not be changed based on short-term market conditions. Within this core, allocate a portion to precious metals. For most people, this should be between 5 and 10%. This is enough to provide meaningful protection if the macro scenario deteriorates, but not so much that it dominates your portfolio. Outside your core, you might have a small tactical allocation that you adjust based on valuation and your macro view. This might be called satellite or tactical holdings. This portion can be more actively managed. It can be increased when prices fall and your thesis is still intact. It can be reduced when prices rise significantly and you want to harvest gains. The key is that this tactical portion should be small relative to your core. You should not be gambling with your retirement. You should be strategically positioning yourself for a specific scenario while maintaining enough diversification that you're protected if that scenario doesn't occur. This approach has several benefits. It gives you the patience to hold through volatility, because the tactical portion isn't huge. It gives you the ability to profit if your thesis is correct, because you're positioned. And it gives you protection if your thesis is wrong, because you haven't bet everything on it. This is how professional investors approach the market, not with conviction so strong that they'll lose everything if they're wrong, but with enough conviction that they'll profit meaningfully if they're right. In today's environment, information moves incredibly fast. The moment something changes, the Fed moves, the Treasury issues new guidance, a central bank makes a purchase, it's spread across social media within minutes. The question is, how do you stay informed without being overwhelmed by noise? First, establish a few reliable sources. Find one or two financial publications that have a track record of accuracy and thoughtful analysis. Read them regularly. Don't jump between sources based on what feels most urgent. Second, understand the difference between price signals and information signals. When gold rises, that's a price signal. The market is repricing it. But it's not information about why. Read analysis to understand the why, but don't be controlled by it. Prices are often right before the information becomes obvious. Third, pay attention to what sophisticated investors are doing, not just what they're saying. Central bank purchases, large fund flows, and strategic positioning matter more than any individual analyst's opinion. These actions reveal true conviction. Fourth, maintain intellectual humility. The world is complex. Your view will be wrong sometimes. Be willing to update your thesis as new information arrives. The ability to change your mind when evidence warrants it is a strength, not a weakness. Finally, remember that understanding this landscape doesn't require you to be right about every detail. You just need to be roughly right about the big picture. You don't need to predict exact prices or timing. You just need to understand that fiscal deficits, currency pressure, and policy accommodation make precious metals more valuable. If that's true, the specifics take care of themselves over a sufficient time horizon. I would be remiss if I didn't mention the geopolitical backdrop, because it's relevant to precious metals in ways that pure economics alone wouldn't explain. The world is becoming increasingly multipolar. The dollar's dominance is less absolute than it was. Alternative currencies, trade mechanisms, and financial infrastructure are being built. This creates uncertainty about the future of the dollar's role. In times of geopolitical uncertainty, precious metals are insurance, not just against inflation, but against the possibility that the system itself changes in unexpected ways. If the international financial architecture shifts, if new currency arrangements emerge, if trade patterns shift dramatically, precious metals maintain value across systems. This isn't cynicism, it's prudence. When you're uncertain about how the world will be structured in 10 years, holding some value in a form that's recognized across all systems is reasonable. This geopolitical element adds another layer to the case for precious metals, beyond the pure macroeconomic arguments. It means that even if inflation surprises to the downside, precious metals might still perform well because of shifting power dynamics and policy uncertainty. Let's talk briefly about the different ways to gain exposure to precious metals. Physical gold and silver are the purest play. You own the actual metal. You bear storage and insurance costs. You have to physically manage your holdings. But you own something that will have value across any financial regime. Physical precious metals are particularly valuable for investors who are pessimistic about the financial system. If you believe in the system's stability, physical metals are less necessary. If you're significantly more pessimistic, they have strategic value. Precious metals, ETFs offer convenience. You can buy them through your regular brokerage account. You can sell them instantly. There's no storage headache. But you're relying on the ETF to actually own the metal in the financial system to function. In a severe crisis, this might matter. For most investors, ETFs are a reasonable choice. Mining stocks offer leverage. When gold prices rise, mining company profits can rise faster, and stock prices can appreciate more dramatically. But you're also buying a company's operational risk, management quality, and other factors, beyond just the metal price. Mining stocks can underperform even when gold is rising if the mining company has problems. For aggressive investors with good research capabilities, mining stocks can be appropriate. For most investors, they add unnecessary complexity. The right choice depends on your goals, your risk tolerance, and your view of the financial system. There's no single right answer. Let me set proper expectations about timing, because this is where many investors fail. If this thesis is correct, if precious metals are beginning a multi-year secular bull market driven by macro factors, it doesn't mean prices will rise every day, every month, or even every quarter. It means that over a period of years, the trend will be upward. Within that trend, there will be significant corrections. Corrections of 20, 30, or even 40% can occur within a multi-year bull market. These corrections can last months or even over a year. Investors who don't understand this get shaken out of their positions, miss the recovery, and conclude that the thesis was wrong. But the thesis wasn't wrong. Their patience was. If you're investing in precious metals, you should be preparing mentally for this reality. You should be investing with money you won't need for at least 3 to 5 years. You should be able to tolerate seeing your position down significantly without panicking. This isn't a quick profit opportunity. This is a long-term structural positioning. The timeline for this scenario to fully play out is probably not years. It's probably 5 to 10 years or even longer. By that time, you should expect to see very different price levels than we see today, but you should not expect that journey to be linear or comfortable. Before we conclude, let me highlight a few more critical mistakes to avoid. Don't assume that because one analyst or one model predicts high prices, that's certain to happen. Predictions fail constantly. Markets are driven by probabilities, not certainties. Smart investors base their positions on probability and are willing to be wrong. Don't use precious metals money that you can't afford to lose. This is especially true if you're new to investing. Build your foundation first. Only use money on precious metals that's above and beyond your core portfolio needs. Don't ignore warning signs if they emerge. If the government successfully addresses fiscal deficits through spending cuts and tax increases, the case for precious metals weakens. If inflation is controlled and real interest rates stay positive and rising, precious metals become less attractive. These would be signals to reduce your position. Being committed to a thesis doesn't mean being blind to contrary evidence. Watch the yield curve, credit spreads, and foreign holdings of dollars. These are indicators of whether the macro scenario I've described is playing out. If these indicators move contrary to the precious metals thesis, be willing to reconsider. Finally, avoid the trap of believing that because you've positioned yourself in precious metals, you no longer need to think about other parts of your portfolio. You do. Precious metals are insurance. They're not a replacement for thoughtful stock selection, bond allocation, and diversification. Treat them as a component of a larger strategy, not as the strategy itself. Let's connect this back to something concrete. What does any of this mean for your actual financial life and decisions? First, it means understanding that the financial environment has shifted. The rules that governed investing for the past 15 years are changing. Recognizing this shift gives you an advantage over people who are still operating based on outdated assumptions. Second, it means taking the time to educate yourself about scenarios beyond the consensus view. Consensus views are often right, but they're always reflected in prices. If you want to profit, you need to see what consensus is missing. In this case, consensus has been dismissive of precious metals. Understanding why consensus might be wrong is valuable. Third, it means building a portfolio that reflects multiple scenarios, not just one. You should be positioned to benefit if the scenario I've described occurs, but you should also be positioned to handle scenarios where it doesn't occur. This is what good risk management looks like. Fourth, it means recognizing that your financial future is not just about picking the right stocks or the right bonds. It's about positioning for the big structural changes that drive returns over decades. Precious metals are one component of that positioning. Finally, it means adopting an investor's mindset rather than a trader's mindset. Investors think about structural changes and position themselves over years. Traders think about short-term moves and try to catch every wave. For most people, the investor's mindset produces better results. We live in a time of genuine financial uncertainty. The fiscal deficits are real. The currency pressures are real. The policy incentives are real. These aren't theoretical concerns or far future problems. They're present-day realities that will shape financial outcomes. What I've tried to do in this conversation is help you think clearly about these realities and what they mean for precious metals specifically. I haven't tried to convince you that gold and silver will definitely soar. I can't promise that. What I have tried to do is show you that the incentive structure has shifted in a way that makes precious metals more attractive than they have been in a long time. Whether you choose to position yourself in precious metals is a personal decision. It depends on your financial situation, your risk tolerance, your time horizon, and your own view of the macro scenario. What matters is that you make this decision based on understanding, not based on hype or fear. The investors who will do best in the years ahead are not those who guess perfectly about prices. They're those who understand the structural changes underway, who position themselves thoughtfully over time, who maintain discipline during volatility, and who avoid the emotional reactions that destroy most portfolios. If you hold precious metals, you now have a clearer understanding of the macro thesis behind that holding. You can hold more confidently, knowing that you own this because you understand the incentive structure, not because you got lucky or followed a tip. If you don't hold precious metals, you now have a framework for deciding whether you should. You know the reasoning, you know what to look for to validate or refute the thesis. You have time to research and decide deliberately, without the pressure of chasing a fast-moving market. Most importantly, you understand that financial security doesn't come from being right about the next move. It comes from understanding cycles, positioning deliberately, maintaining discipline, and staying educated over a long period of time. That's the mindset of someone who preserves and builds wealth. That's the mindset that matters. Thank you for taking the time to think through this with me.